Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The past week has been a monster for economics. Last week it was the GDP data, with Australia staying out of a recession, for now at least. Then yesterday the board of the Reserve Bank held its monthly meeting. To help work through all that, I welcome back Cacho, Chief Economist at Jarden Group. Carlos, welcome back to Fear and Greed.
Thanks for having me, Sean. Happy to be here.
Delay but not derail. Is that the message from the Reserve Bank?
That seems to be what they're telling us in the meeting statement, certainly versus their SOMP forecast from August or Statement of Monetary Policy forecast from August. There's a pretty significant near-term downside miss to GDP, but they've really danced around that issue and really pinned their hopes on a very strong recovery when restrictions are eased at the other side of lockdowns.
Okay, so what were the key messages out of yesterday's statement?
Look, really, it's that they still expect a strong recovery to come through. That near term, yes, there are downside risks to the outlook, and yes, the economy is going to be materially worse than they expected, but that they expect that once restrictions are eased, we're going to see a solid recovery as pent-up demand is unleashed. They do concede that the pickup is probably going to be a bit softer than last year's recovery. In our own view, we think there's probably some risk to that. We think that this transition to living with COVID is probably going to be a bit more challenging than many expect. And that means that even when lockdowns are lifted, the economy might still be a bit softer than what we hope.
Yeah, it was interesting reading the statement yesterday because it looked as if the board of the bank was kind of upbeat, but exactly what you just said then, it's a different way out of lockdown this time around compared to last year.
Yeah, I think that's a really important point. Last year, and even the lockdowns we saw earlier this year with Melbourne's fourth and fifth lockdowns, were all ended when cases got to zero. So when restrictions were eased, the public could largely return to normal life without any concerns of community transmission. This time, what we're going to see is we're seeing vaccination really being the driving force of easing of lockdowns, particularly in New South Wales and Victoria. What that's going to mean is hopefully the vaccinations mean that prevalence of severe cases and hospitalizations remain fairly low, but it's likely that community transmission of COVID is going to pick up or remain relatively high, which is a big difference. If you think about your decision to go out and partake in economic activity, you're potentially exposing yourself to a virus which we haven't really had much exposure to in Australia. In the UK or US, where they've gotten used to very high levels of cases, having that ongoing level of cases is less of a concern. Here, I think it will be a bit of a challenge psychologically and behaviourally for people.
Now, just before we go any further on that, and staying with the bank statement yesterday, what are they doing on the tapering of bond purchases?
So the RBA decided to proceed with the planned tapering bond purchases. So prior to September, they'd been purchasing bonds at a rate of $5 billion a week. They're going to now taper that down to $4 billion a week. They did concede, though, that they were going to maintain that rate till at least February next year, whereas previously they'd suggested they'd review it again in November. So they've given a slight concession to the deteriorating outlook by keeping that purchase rate a little bit higher for a little bit longer. To us, I think one key thing out of this is the decision to continue tapering, despite the significant miss to their outlook, suggests potentially that there's some unspoken concerns the RBA has about the QE program that are also in their thoughts. And I think the two key ones would be the fact that their ownership of the bond market is getting to a very high level. And so they probably don't want to push it too much more, or they may risk the kind of strong functioning and liquidity of the market. And the second one is that they do remain quite concerned about the strong rise in house prices and the run up in lending. And I think they don't want to risk putting any more fuel on the fire with putting downward pressure on rates from here.
But they're not talking about inflation at this point, are they?
No, they're definitely not concerned about inflation right now. The latest wage figures out for Q2 remained fairly soft. CPI, while it had a significant rise in June, that's largely temporary, and it's due to really the very weak results from last year falling out. So they're not at all concerned about inflation at the moment.
Okay, so when do you think interest rates will eventually rise? It's clearly not anytime soon.
No, look, it's still definitely some way off. We're hopeful that by mid-2023, the right building blocks will be in place for the RBA to begin hiking rates. But even then, it's going to be a very gradual process. We're not going to be seeing anything like the rate hikes we've seen historically. It's probably going to be looking at most one hike a quarter, if even that. So, you'd look at rates going up probably less than 1% a year. So it is going to be a very, very gradual pace of rate hikes.
So that's a couple of years away. In the meantime, and sort of the difference between now and the end of the global financial crisis, back then the world had quantitative easing and low interest rates, but it didn't quite have the fiscal spending that we've got this time around. Do you expect governments to start pulling back on spending in the next couple of years?
Look, I think we're going to have that discussion around fiscal stimulus and some budget consolidation at some point. For the moment, obviously, in the midst of another kind of economic downturn, that's not really on the radar. But I do suspect after the next election, which is due by May next year, we'll probably start seeing the governments have to make some hard choices when it comes to that. What we've learned through this crisis is I think that fiscal spending really can avoid the worst impacts of a recession. And I think that is going to change probably fiscal behaviour in recessions or negative shocks going forward.
Yeah, it is very interesting how fiscal policy really has come to the fore over the last 12 months or so.
It has. And, one of the things the RBA had been calling for quite a while pre-COVID was for some help from fiscal. We'd had a situation where monetary policy was being eased to try and support the economy to drive growth and a pickup in inflation. But on the other side, you had fiscal policy continually tightened and the move to ever closer towards a surplus, which we get so close to.
Yeah.
I think what we've seen this time is we've actually seen those two levers of policy working in tandem, and it really shows you how effective they are. But going forward with the RBA already at zero and with QE already being used and the RBA owning quite a good chunk of the bonds that they're purchasing, that ownership is probably going to get close to 40 or 50% of some of those bond lines.
Wow.
Really, it's going to be fiscal policy that drives stimulus in any future shocks. It's monetary policy doesn't have a whole lot of fuel left.
Yeah. Stay with me, Carlos. We'll be back in a minute. My guest this morning is Jarden Chief Economist Carlos Cacho. So just bringing it a little bit closer to home, what's your prediction for GDP in the December quarter?
In the December quarter, hard to say at this stage. It's really going to come down to the health outcomes and when lockdowns end. But look, we'd be hopeful that we'd see something around a 2% pickup in growth, but very, very highly uncertain right now.
And a negative quarter this quarter?
Yeah, this quarter it's looking like it could be anything from -2.5 to -4. Very, again, hard to pin down. The fall in consumption we're expecting in New South Wales and Victoria alone is enough to probably see -2.5 to 3. So you add to that a bit of weakness in the construction sector, less interstate travel, a few other areas that are softening. And I think, it is going to be a very, very soft quarter. Probably the outside of 2020's recession, probably one of the worst quarterly results for GDP on record.
Wow. So the $64 question for most of us who don't live in your world, house prices. Carlos, tell me, what's going to happen?
Well, all the leading indicators still suggest the housing market has not been dented by Delta. We've got auction clearance rates moderating, but still remaining consistent with pretty solid house price growth. The latest data from CoreLogic continues to show price growth above 1% month on month. So our expectation is still that we probably see another 10 to 15% price increases from here, largely based on low interest rates feeding into higher borrowing capacity. That means that this cycle will probably see house prices appreciate around about 25 to 30%.
That's pretty good, like all in all. Do you think regulators will be worried about that?
Look, I definitely think it's something they're focusing on. Actually, yesterday, as well as the RBA, we also had APRA release the latest data on lending characteristics, which shows this high-risk lending and detail of lending standards that the RBA and APRA are watching very closely. And what it showed was a really mixed and interesting picture. On the one hand, you've got a situation where higher LVR lending, so that's people who are borrowing more relative to the value of their house, has actually gone down. Interest-only lending was also lower. But then you saw higher debt-to-income lending, which is people who are borrowing a relatively large amount of debt relative to their income, or greater than 6 times their income, went up quite materially. And of course, we know that investors are really coming into the market in quite a number again. So you've got some areas where things are looking pretty good and others where there's maybe some concerns. I definitely think the regulators are watching it closely, but in the midst of an economic downturn, they're not about to tighten macroprudential policy. And I still think it's much more of a story for 2022 than 2021.
Carlos, as always, thanks for talking to us.
Thanks for having me, Sean.
That was Carlos Cacho, Chief Economist at Jarden Group. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.